HSBC's market December services PMI down at 50.9, the lowest level in more than 2 years, and it follows the official reading of 54.6, a 4-month low. Joining us for more, Stephen Sun, Head of China Equity Strategy at HSBC, along with Yannick as well. Stephen, thanks for joining us. Chinese stocks didn't do that well last year, down some 7%. They're down 4% so far this year. How much of a concern are these PMI numbers in that?
Well, certainly that tells you the growth momentum is decelerating. I think, if you look at the major drivers for growth, investment, consumption, and also exports, certainly, consumption has been quite resilient. But, there could be some downside risk on the investment side, given that cost of funding in China is going up. In June, we had the liquidity crunch. I think that's the first wake-up call that cheap liquidity is quickly running out in China. And then we had the second wake-up call since November last year, i.e. the yield spike in the interbank market. And certainly, the investment is heavily depending on cheap liquidity. So that's a downside risk. In the meantime, I think, investors are hoping that external demand could pick up so that to provide some cushion to growth for this year. So overall, this year we think it could still be like last year, i.e. a stock picker's market.
George Soros is arguing that the nation's growth model has run out of steam. It's his biggest concern this year. What's your biggest concern about China?
I think the fact that the new leaders needs to balance well between maintaining some minimum level of growth, i.e. 7%, in order to generate 12 million jobs. While in the meantime, obviously, they're facing a lot of, challenges down the road in terms of rebalancing the economy. I think from cutting back overcapacity to, force some level of deleverage in the interbank system, and also controlling the local government debt, as well as, cleaning up financial sector. I think there's a quite high, task for them to balance well all this challenging task.
Yeah, I think what's happening in China is very interesting because on the face of it, you have in the US, stock market went up 30%. In China, it's down. In the US, the price earning is above 25 times. In China, is around 7.7 times. So therefore, there should be some value investing going into China. Having said that, the picture in China is not really improving. We have bad news after bad news. The biggest news recently was on the 30th of December. It was the audit. They sent 56,000 auditors in almost 400 cities in China, and the result was not very good. Local government could have a debt of 33% of GDP. We're talking about a very, very, very large number. And what we have seen in 2013 is the economy having the lowest interest rate or the most accommodative monetary policy, have the stock market that performed the most. So therefore, it's very important to have a very low cost of funding and very low interest rate, because if you start the year with, right now the repo, the interbank lending rate is 7 days is around like 4.5%. Yeah. It probably is going to go up again towards Chinese New Year, and there's some structural, I think, problem linked to local government funding and the shadow banking that will push again this interest rate higher, I think.
Do you see that happening, Stephen? And clearly, compared to the rest of the world, there must be some value in Chinese stocks, mustn't there, or not?
I think, it's very tempted to look at the valuation and say in China is a good buy at the current level. But in fact, if you look at the funds flow, we see some moderate funds inflow in October, November last year. But unfortunately, the funds are leaving the Hong Kong market, the China stocks, in December. Fundamentally, I think, investors, particularly the long-only investors, have yet to be convinced that, all these reform acts could be carried out smoothly in the coming year. And even if they could carry out those reforms as planned, usually in the short term, that means more pains, i.e. slower growth and higher market volatility, and also higher volatility in the financial sector, which may not be positive for the stock market.
Yeah. We'll leave it there. Stephen, thanks very much for that. Stephen Sun, Head of China Equity Strategy at HSBC. Yannick, we'll come back to you in a second. Now, as I mentioned, billionaire hedge fund manager George Soros says a slowdown in China is his biggest concern for the year. Writing in an opinion piece on Project Syndicate, he said 3 years of worrying about the Eurozone should now give way to the rising risk of a hard landing in China. He's argued that the nation's growth model has run out of steam. So we want to know,